Hey everyone, welcome back to Corporate Decoder. Today, Manhattan Bridge Capital Incorporated or Manhattan Bridge Capital Incorporated Loan just filed their quarterly report for the period ending the 30th of June 2026, and I am seeing a mixed bag of results with one significant red flag emerging. Quick note, this is not financial advice, just my take on public filings for educational purposes. While revenue is down, the company is managing its debt. But a potential foreclosure situation in Florida is something to keep a very close eye on. Alright, let's dive right into this filing from Manhattan Bridge Capital Incorporated. This is their quarterly report, which gives us a look at their financial health over the last 3 and 6 months. First up, the balance sheet as of the 30th of June 2026. Total assets stand at about $64 million, a nice increase from around $62 million at the end of last year. The biggest piece of this is loans receivable, which has grown to nearly $62 million. This tells us they are actively lending money, which is their core business. On the flip side, liabilities have also increased, mainly due to higher lines of credit, hitting over $19 million. Their total liabilities are about $21 million. Now, let's look at how they made money, or in this case, how their revenue has changed. For the 3 months ending the 30th of June 2026, total revenue was about $2 million, down from roughly $2.3 million in the same period last year. For the 6-month period, revenue also saw a dip, coming in at about $4.1 million compared to $4.6 million last year. The company explains this decline is due to lower interest rates and origination fees, which is a consequence of higher competition in the market. They also mentioned giving out some discretionary credits to borrowers, which reduced revenue. With that revenue drop, net income for the 3 months ended the 30th of June 2026 was about $1.15 million, down from about $1.4 million in 2025. For the 6-month period, net income was around $2.4 million, down from about $2.78 million in the previous year. So, while they are still profitable, their profit margins are getting squeezed. Looking at cash flow for the 6 months ended the 30th of June 2026, the company generated about $2.69 million from operating activities. This is a bit higher than the $2.4 million from the same period last year. This increase is mainly due to changes in receivables and escrow deposits. However, investing activities used about $1.7 million, mostly from issuing new loans, which is less than the positive cash flow from investing in the prior year. Financing activities show they used about $958,000, mainly for paying dividends, whereas last year they used over $2.5 million. Shifting gears to a more detailed look at their loan portfolio, the company offers short-term secure loans to real estate investors, often called hard money loans. These are typically for 1 year and are secured by real estate at the 30th of June 2026. Their total outstanding loans were valued at over $62 million, up from about $60 million at the end of last year. This table shows us how their loans are categorized. The vast majority of their loans, over $51 million, are for residential developers. Another $9 million are for commercial developers. It's good to see they are primarily focused on residential and commercial development, which aligns with their business model. Now here is that red flag I mentioned in the second quarter of 2026, a borrower with a loan of about $935,000, secured by properties in Florida, has become delinquent. They have not made interest payments for about 3 months and have not responded to default notices. The company has hired lawyers to start foreclosure proceedings if needed. They believe the property value is more than the loan amount, so they are not having to set aside money for potential losses right now. But this is definitely a situation to watch closely. This mirrors what we saw with other real estate lenders facing challenges in their portfolios when interest rates changed rapidly. Similar to what happened with some lenders after the 2008 crisis. Let's talk about their financing. They have credit lines with Webster Bank and Flushing Bank totaling about $32.5 million. Recently, in March 2026, they extended the maturity of this credit facility to February 2029. This is positive as it gives them more breathing room. Borrowings under this line can have interest rates tied to SOFR, the secured overnight financing rate, or a base rate plus certain fees. These rates can fluctuate. Additionally, their subsidiary has a credit line with Valley National Bank for up to $10 million that matures in December 2027. These credit lines contain typical covenants, which are basically rules and requirements the company must follow, like maintaining certain financial ratios and limiting how much they can borrow based on the value of their assets. They state they are currently in compliance with all these rules. Looking back at net income for the 6 months ended the 30th of June 2026, it was about $2.4 million. This is down from over $2.7 million in the same period in 2025. This 12.9% drop is primarily due to lower revenue, partly offset by lower interest expenses. In terms of liquidity at the 30th of June 2026, they had about $230,000 in cash. They believe their current cash borrowing capacity from their credit lines and operating cash flow will be enough to cover their needs for at least the next year. It is worth noting that their credit agreement with Webster and Flushing was amended in March 2026. This amendment extended the credit facility maturity to February 2029, which is a good sign for their long-term financial planning. Let's revisit the revenue trend for the 6 months ended the 30th of June 2026. It was approximately $4.1 million, a decrease of about 11.1% from $4.6 million in 2025. The company attributes this to lower interest rates and increased competition, which is a common challenge for lenders. Similar to how we've seen other mortgage and lending companies in the market face margin compression when interest rates are volatile. And for that 6-month period, net income was about $2.4 million, down from $2.7 million in 2025. This decrease of almost 13% is driven by that lower revenue, though they did manage to reduce their interest expenses, which helped soften the blow. Their stated objective is to grow their loan portfolio thoughtfully, aiming for good returns while protecting shareholder capital, and they are committed to paying dividends. They believe market conditions are favorable for originating high-quality loans. Looking at the management's discussion, they highlight their specialization in short-term secured loans for real estate investors. They mentioned that a key factor affecting their business is the competitiveness of the market, which is impacting their revenue. They are also actively managing their credit risk, especially concerning the Florida loan issue. As a smaller reporting company, they are not required to provide detailed disclosures about market risks, like interest rate fluctuations, which simplifies their reporting requirements. The company states that their internal controls and procedures for financial reporting are effective as of the 30th of June 2026. This means they have systems in place to ensure that the financial information they report is accurate and timely. They also have a share repurchase program as of the 30th of June 2026. They had repurchased over 13,000 shares in May 2026. They bought back about 3,800 shares at an average price of $4.23. This indicates they believe their stock is a good value at current prices. Finally, the exhibits list includes important documents like amendments to their loan agreements and certifications from their CEO and CFO, confirming the accuracy of the report. Now, putting it all together, Manhattan Bridge Capital Incorporated is operating in a challenging market with increased competition driving down revenue. They are managing their debt well and have extended their credit facilities, which provide stability. However, the delinquent Florida loan is a significant concern. While they are confident in the collateral, loan defaults can lead to unexpected costs and losses. This situation, combined with the overall revenue decline, suggests caution. The company does seem to be focused on managing its capital and returning value to shareholders through dividends and share buybacks. The risk I am watching is the ongoing situation with the Florida loan, and whether it will lead to a significant write-off or require extensive legal costs. My biggest concern is whether they can maintain profitability and dividend payouts if competitive pressures continue to squeeze their margins. What I am actually looking for next is how they plan to navigate this increased competition and manage any potential fallout from the delinquent loan. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Check out the Discord in the description.